I'm going to share with you 8 legal capital gains tax exemptions that you can claim to pay 0 CGT in Australia when selling real estate, land or inherited property, investment or rental properties, transferring property to a family or a trust, or during a divorce, separation, or relationship breakdown. These exemptions are CGT free, but you still need to report them on your tax return. Due to time constraints, I will show you how and where to report them in a separate video. If you're new here, I'm Veronica, a registered tax agent and a certified trainer and assessor in Australia. Quick disclaimer, this video is intended as general and educational information only. So let's dive in. What is capital gains? A capital gain is a net profit that you make when you sell a capital asset for more than it cost you. And what is capital assets? Capital assets are assets like your home, investment property, land, shares, units in a unit trust, and cryptocurrencies, etc., just to name a few. For full details, please see the link in the description box below. Now, what is a capital gains tax? A capital gains tax is the tax you pay on your net capital gain. In Australia, CGT has a different tax treatment but does not have a separate tax rate. How capital gains tax works is simple. Your net capital gain is added to your assessable income. Then your assessable income is reduced by any allowable deductions like work-related expenses. That gives you your taxable income amount. The taxable income amount is the amount that the ATO will tax you on at your marginal tax rate, plus any of these 4 applicable components here if you're an individual, okay? I've shared a video on 18 tax deductions that you can claim to maximize your refund or how to pay less tax, so watch it after this if you haven't. Now, if you are eligible for any one of these 8 property tax exemptions, that gain will be CGT exempt. There are 3 things that you have to remember as they apply across most CGT exemptions, okay? 1, real estate CGT is triggered on the contract to contract date, not settlement to settlement, okay? This means that the date of the disposal is the date you sign the contract to sell, and the date of purchase is the date you sign the contract to buy. One question that I get asked so often is, how long do I have to live in a house before selling to get that 6-year rule or main residence exemptions? There are no set time by the ATO, but section 118-135 says that you must move in and use it as main residence ASAP. So if you rent it out before moving in, partial CGT will apply, okay? Many people confuse this with the SRO's 12-month stamp duty exemptions. They are different. The SRO, the ATO, and many government executive agencies share data, but each has its own separate rules, okay? So if you receive stamp duty exemptions, the SRO may take it back if requirements aren't met, okay? Now, thirdly, what is main residence in CGT? The ATO defines a main residence as a dwelling that sits on 2 hectares or less block of land. A dwelling means a house, a boat, or a caravan, etc. You and your family have to actually live in it and not board it and intend it to. You need proof like personal belongings, mail delivery, electoral roll, and driver's license. Also, utilities like phone, gas, power, and water, etc. must all linked to that address. Here's your 8 CGT exemptions. Exemption number 1. Property owned before 20th of September 1985. So if you acquired aka owned properties before 20th of September 1985, they are considered as pre-CGT assets, and any gains from these sales are disregarded, aka CGT free in Australia. That's because Australia didn't have CGT before this date. CGT was introduced by the former Treasurer, Mr. Paul Keating, under the Hawke government on the 20th of September 1985. The tough part is if you made any capital improvements or additions or change how it's used on or after this date, part of that gain might still be taxable. So check the ATO guide at QC 66043 for more details. Exemption number 2, transfer of investment property due to a divorce or de facto breakup. This is a very powerful CGT relief that most people have never heard of, well, except for divorce and family lawyers, of course. So under section 126-5 of the Income Tax Assessments Act 1997, when you separate or divorce, investment properties or assets you transfer to a spouse or a former spouse because of a marriage breakdown usually qualifies for a CGT rollover relief. But here's the snag. The transfer must be under a formal qualifying agreement like a court order, a binding financial agreement, or consent orders under the Family Law Act 1975. Otherwise, private agreements will not qualify. Okay? Say your name is Adam and your ex-wife, Lilith Genesis, jointly own an investment property. Judge Enoch's court orders you to transfer your share to Lilith. Because it's under court order, you don't pay CGT now. Instead, CGT roll over to Lilith. So always ensure that the formal agreement lists Lilith's full legal name on it as the transferee, aka the receiving party, okay? And not redirected to a company, a trust, or SMSF, etc. So later, when Lilith sells the property, she will pay CGT, not you. Otherwise, the ATO will hit you with CGT, like in the case of Allison and Sandini 2018, FCA FC 44. Exemption number 3, the CGT 6-year rule for main residence exemptions. If your main residence stops being your main residence and you rent it out while you're absent, Section 118-145 lets you legally avoid capital gains tax on rental properties for up to 6 years. During this 6 years period, you cannot claim any other property that you own as your main residence. And Section 118-135 requires you to move in ASAP after you bought it and settle it. So say in year 0, you bought a home on the 1st of July 2019 and you actually lived in it for a year as your main residence. Then in year 1, on the 1st of July 2020, you moved out, say, to live with mom and rented it till the 30th of June 2026. That's from year 1 to the end of year 6. You treated this property as your main residence and you didn't declare any other property you own as your main residence during this 6 years period. To be entitled for this 6-year absence rule before the exemption date, which is 30th of June 2026, you got 2 options. Option 1 is sell the rental property before 30th of June 2026 to avoid full capital gains tax on rental property. Or option 2, move back in to reset the 6-year clock. You can reset it indefinitely, provided that you move back anytime before the 6-year ends. So what happens if you exceed the 6-year limit? Then CGT starts on the 1st of July 2026. So if you don't plan to move back before then, get a professional valuation from when the property first earned income to reduce CGT in the future. Now, does the 6-year rule apply to non-residents? The answer is yes if you return back to Australia and sell before the 6-year ends. And no, if you sell while you're overseas, CGT applies even if it was your only main residence, okay? Exemption number 4, the 2-year rule on a dwelling acquired from a deceased estate, aka inherited property. So capital gains tax on inherited primary residence may be exempt if you meet one of these criteria. A, you inherited from someone who died, aka the deceased, on or before 20th of September 1985. B, the deceased acquired it pre-CGT and you sold it within 2 years of their death. C, if the deceased acquired it post-CGT asset and you inherited before 20th of August 1996, then it's exempt if property was the deceased's main residence before passing and the sale settled within 2 years of their death, okay? So if you sell it within 2 years, it's exempt, even if you used it as main residence or you rented it out. Okay, if you don't meet this 2-year mark, the ATO may grant an extension for exceptional delays. So see your eligibility at QC 66057. D, if you inherited the property after 20th of August 1996 and you didn't sell it within 2 years or no extension is granted, to qualify for this exemption, the house must be the main residence of you or the deceased spouse before passing or other beneficiary and not rented or used to earn income. Now, you may get a partial CGT exemption if the property produced income. So CQC 66055. So what happens if you inherit a previously inherited property? If the deceased acquired it after 20th of September 1985 as beneficiary or as trustee, exemption applies depends on the total days it was main residence of you and the previous beneficiaries. So CQC 66055, for example. Okay, and if the deceased and you were foreign residents for more than 6 years, no main residence exemption applies. Okay? Exemption number 5, transfer of property to the trustee of a special disability trust for no payment, aka SDT. So if you have an immediate family member with severe disability, aka disabled beneficiary, the ATO lets you gift assets and property to a complying SDT without triggering CGT. SDT started in 2006 via the Social Security Act 1991 to help families privately provide funds for care and accommodation needs without affecting the disabled beneficiary's disability support pension eligibility. So you can gift property, stocks, etc. up to a total of $500,000 to an SDT tax-free, provided that you're an immediate family member at or over service pension age and receiving Centrelink pension. More details about SDT can be found via the link in the description box below. Exemption number 6, transfer of main residence as a result of divorce or separation. Under the relationship breakdown rollover relief, if the property was the main residence of you or your former spouse, you can claim full main residence exemption from CGT if the main residence was transferred to you after 12th of December 2006 and before the transfer your spouse used it as their main residence. While you owned part of it, you used it as your main residence and the property wasn't used for rent or business. And if it was transferred before 12th of December 2006, after the transfer, it was your main residence and it wasn't used for business or rent. And if you don't meet these criteria, CGT may apply, but you might get a partial main residence exemption. Exemption number 7, the main residence exemption in Australia, aka MRE. So the main residence exemption has more benefits than you think, okay? So you can legally avoid capital gains tax on your house, aka home, if the property wasn't used to produce assessable income. However, CGT may apply and be apportioned if you rented or ran a business from home and claimed business deductions. It wasn't your main residence for the full ownership except for the 6-year rule. Okay, you were a foreign resident and didn't satisfy the life events test at sale, like terminal illness, death of a spouse or children, or divorce. And it sits on a block of land that is more than 2 hectares. Now, can you claim more than one residence at once? The answer is no. The ATO only allows one main residence at any given point in time, except if you acquire a dwelling to become your main residence and still own an existing main residence, you're considered to have 2 main residences. So both can be treated as main residence for up to strictly 6 months only. This is called the 6 months transitional period, provided that you lived in the existing main residence for at least 3 consecutive months in the 12 months before sale. It wasn't used to earn income during any part of those 12 months when it wasn't your main residence. This 6 months concessions applies even if you made a choice under Section 118-145 and Section 118-150 for building, renovating, or repair to your main residence. That's the key to how you avoid paying capital gains tax on your house. But if it takes longer than 6 months to dispose of the old main residence, then you can choose to treat the old main residence as full main residence exemption on sale. However, this may impact on your ability to claim full exemption on the new main residence when sold later. Exemption number 8, adjacent land of main residence exemption. Aside from the 6-year rule exemption, this is one of the most generous and legal ways to avoid capital gains tax when selling adjacent land with your home. So the land adjacent to your home may be exempt as part of your capital gains tax exemptions on sale of primary residence if you meet all of the following. The adjacent land is mainly used for private and domestic purposes in association with the main residence, like a garden, a shed, or personal use space. 2, the total land size, including the dwelling, the land it sits on, and the adjacent land must be equal or less than 2 hectares. Okay. 3, the adjacent land must be close, near, adjoining, or neighboring to your main residence dwelling. So that means it doesn't have to physically touch or connect with your dwelling. 4, the adjacent land must be sold with your main residence dwelling. And lastly, 5, you did not use the adjacent land to produce income. So CQC 64895 for a full example. That's how you avoid capital gains tax when selling investment property in Australia legally. Watch this video next to claim 18 deductions to maximize your refund, or how to pay less tax. If you find this content useful, please like, subscribe, and share, guys. And if you've got any questions, drop them in the comment below and I'll try my best to reply.